Chapter 1.3, Determining how revenue, expense, and withdrawal transactions change the accounting equation. This lesson we're going to talk about a business owner by the name of SpongeBob. He operates a service business called SpongeBob's Service Company. He uses the following accounts, and then we need to complete the transactions. He uses cash, accounts receivable, supplies, prepaid insurance, accounts payable, and capital. Real quick before we hit to that first transaction, another clarification: the difference between accounts payable and accounts receivable. If you are going to have to pay someone money in the future, that is accounts payable. If you are going to be receiving money in the future, that is accounts receivable. Okay? You buy something on account, that's accounts payable. You sell something on account, that is accounts receivable. Let's take a look at our first transaction here, though. Paid cash for rent, $300. Well, the word is paid cash. So obviously paid means decrease in our cash, so we are going to have less cash, $300 less cash. And now we need to figure out, okay, well, what is it going to be? Do we owe someone money is someone going to pay us money in the future? Nope, so it's not going to be accounts receivable. Do we have more supplies? Nope. Do we have prepaid insurance? Nope. Do we owe someone money in the future? Nope, not at all. It is actually an expense. It's a rent expense, and a rent expense goes under owner's equity for a minus 300. Okay? Now let's figure out our new balances. If our beginning balance was 625 and we took out 300, our new balance is going to be 325. Supplies stays the same at 375. Prepaid insurance stays the same at 400. Accounts payable stays the same at 200. Now our capital has decreased down to $700. Next transaction, paid cash. There we go again. So that's going to be a minus 1,500 to the owner for personal use. Now let's go back real quick to what owner's equity is. And owner's equity is the amount remaining after the value of all liabilities is subtracted from the value of the assets. Even more specifically, it's the financial rights to the assets of a business. Well, guess what? The owner took out $1,500 of his own financial rights to the business. So we're going to take $1,500 out of SpongeBob's capital for this transaction. So now my new balance in cash is going to be a negative $1,175. Once again, this can happen. It doesn't happen very often. We hope it doesn't happen very often, but you see that it can happen. Supplies is still the same at 375. Prepaid insurance is at 400. Accounts payable is at 200. And now our capital is a negative 800. We are not going down a very, very happy road. We need to definitely get some more revenue going into this business to be able to get it on the right track. Funny I should say that, because look at our next transaction. It's receive cash from sales. Hey, well, we got some revenue coming in. It's obviously not enough to get us back on track to this business, but you know what? Every little bit helps. We received cash, so cash has increased, so that's a plus $80. We're not going to be we already received it. It's not in the future, so that's why it's in cash, because we have it now. If it would be coming in the future, that's accounts receivable. Supplies, nope, we didn't buy any supplies or get any supplies. We didn't buy any prepaid insurance, and we don't owe anybody money. This will actually go into the owner's equity account under an account which is called a revenue or a sales account, and that's basically an increase in the owner's equity resulting from the operation of a business of $80. New transaction here. New balance is negative $1,095 in our cash. Not good. Supplies is 375, prepaid is 400, accounts payable is 200, and now our owner's equity is negative 720. How do we know if we've done this right? Well, let's take a look here. Is negative 1095 plus 375 plus 400, or in other words, the cash plus the liabilities plus the prepaid insurance, does that equal the accounts payable plus capital? And in this case, it does. 520 equals 520. More so than not, my assets equal my liabilities plus owner's equity. We are in balance. Life is good.